TheoTrade, this is Don Kaufman. It's May 13th, 2019, and you are watching the TheoTrade evening video. We're just a few minutes after the cash close with the S&Ps down about 2.8% as we really start to see volatility kind of gripping hold of this marketplace. You know, as I'm saying that, with volatility kind of gripping hold and the S&Ps, again, they closed down 80. Right? And the Nasdaq here down almost 4%. I mean, we're starting to get to statistically significant moves in the marketplace. Push all of that aside for a second. I'm actually going to switch out to a larger time frame and move over to the VIX because a lot of people, they kind of do follow the VIX. And the thing I think that really bothers me out of today's trading session is simply the VIX. It's just starting to wake up. I mean, we're looking at a VIX that's 20. I'm actually going to give you a couple of arguments during the next few minutes on this evening's video, okay, that you need to be extraordinarily concerned about moving forward because there's a few things on this screen, they just do not add up. And that's precisely what I want to display to you over here. I mean, I can say, listen, volatility is starting to grip hold all day long, but the proof's in the pudding. Let's get down to it. So, cruise back to the S&Ps for just a moment. One of the first things I want to point out about the S&Ps is the S&Ps, they really were adhering to our gravity points today. This is a gravity point up here, 2842. The gravity point down below is 2811. For those of you that are uninitiated, okay, or just don't know about TheoTrade, we have highly specified levels inside of the S&Ps. These are levels that have been in play for 18 plus months, but those two levels, 2842, 2811. The only gravity point that's below the 2811, you got to drop all the way down to 2731. Now, the reason I'm bringing up the gravity points, and I know this is kind of a mess over here, so bear with me. I'm going to cruise to the spiders for a second, and I'm going to close up this left side bar. There was something that I talked about extensively back in the October time frame, October, November, into early December. This back here, people, it's what we call the volatility box, okay? I actually kind of dubbed it the hurt locker. And the reason we were kind of dubbing it the hurt locker is once we actually dropped into this volatility box, we were pinging back and forth, okay? And this, I know this is the spiders, but we're going to call this S&P numbers. We're pinging back and forth from 2,800, okay, right to 2,600. I mean, almost to the level and literally ping back and forth. This right in here absolutely decimated, shredded retail clients, only to see us actually dive harder. At this point in time, the reason I'm bringing this up over here, people, I would not look for us to actually enter just into a volatility box. We come under 2,800. It's going to be a little bit of a free for all. It should be a straight shot down to 2,600. Look for it. Okay. Things are not going to play out exactly the same as they did. And when I start to look back at this left side bar and I start to look at the volatility, again, as I said, things just don't add up when you start looking at the spiders and the overall volatility. Let me show you again, to begin with, what doesn't really add up. Then we'll come back over to the VIX, come to the volatility futures. Let me start with the SPX, okay? So the SPX, on a week-to-week basis, we often look at what we term expected move. Last week, okay, and then, of course, this week. So last week, we absolutely tore a hole on Tuesday through the bottom of the expected move. The markets were anticipating about a $34 move last week, right? So here's this $34 move we're waiting for. What did we get? I mean, this is about a $66 move towards, again, the end of the week. This is Friday, and of course, we bounced back up. We still moved, $30, $40 outside of the expected move, okay? Things took a turn for the worse today, obviously, since the sell-side activity kind of gripped hold. But today, we're already ripped through the bottom of the expected move. Now, that doesn't, I don't want you to discount the idea of a rally back. Listen, in the midst of heavy sell-side activity, some of the most wild moves are the rips back to the upside. I wouldn't be surprised to see as the marketplace reach back up for 2860 at some point during this week, okay? But the point that I'm making with this is a point that I made on the weekend video. If you are out there and you are selling options premium, okay, are you not seeing what I am seeing, okay? Here, I'll point it out even clearer. If you look at the SPX options chain and you open up the 4-day options, okay, 4-day options in the SPX, that's the remainder of the week. This is the Friday, the PM settlement. The marketplace, the entire remainder of the week is only expecting about a $61 move. Now, I got to clarify, when it comes to the expected move, this is not some rabbit pulling a number out of a hat. Okay, this is real. This is tangible. This is what the option market is telling you and depicting risk to be. Like if you look at the marketplace, here we are, the SPX closes, ironically, 28.11, which is literally our gravity point. If you start to look at the at-the-money options, they're pricing in, okay, like a $60 move. That's the at-the-money straddle. That's where that expected move kind of comes from. Why am I bothered by that? Oh, I don't know. Today is something we call Monday. We already moved more than the expected move in one day. So you're telling me that the actual movement in the marketplace has already exceeded the implied volatility for the next 4 days, but some monkey is still going to go out and sell options? You are out of your mind, okay? You're getting actual movement in the marketplace, smoking expected move over here. It is a vast inefficiency in this marketplace. And you should be and I'm forewarning you right now, these expected moves should be expanding out drastically. They are to some degree, but not enough. It's like the marketplace has this wet blanket over it. In fact, I want to show you exactly what I mean with that comment here. This happens to be, okay, the weekend. This is the weekend where I took the expected move. Over the weekend, we only had a $54 expected move for the entire week. So that's what this is right here. That's a $54 expected move. Again, today we moved $70. They expanded the expected move from 54 to 61. People, okay, what are we talking about over here? And we're talking about a VIX that's getting to like 20. Okay, so yawn. Call me when that thing gets up to 25, 30. Call me when the market really starts to rock, because we ain't home yet. And that's one of the things I want to get you guys to kind of fathom, is that we are not home yet. In fact, when you start looking at the volume, even the volume is screaming it. There are so many indications on the screen, okay? Yeah, some risk is here. Yeah, volatility is starting to grip hold a little bit. That's why we're titling the video, Volatility kind of grips hold, right? But we're not rocking yet. I'm not feeling the fear. I like to feel the fear. Listen, don't get me wrong. Days like today are absolutely spectacular for bears like me, okay? Listen, on this trading session, I want to actually point this out because challenge you on your positions. On this trading day, this is an IRA account. This is not a portfolio margin account. This is a standard IRA account. I have $30,000 tied up in margin, okay, with about almost $14,000 in P&L on the day. In terms of contract size, nothing here is huge. Nothing. I mean, you look at some of the positions that I've got on. I mean, a couple of contracts in Caterpillar, 2 contracts in Caterpillar. I got a whopping 3 contracts on inside a city, okay? I mean, Bank of America, it's a big nothing. I'm actually losing money on that position, but it's a big nothing in Bank of America. 3 contracts, okay? But it adds up. A lot of times I talk about trading extraordinarily small, okay? And whatever works, keep with it. On a day like today, look, I only had, 8 fills. Nothing crazy, nothing big, just rolling positions that were working for me, okay? You don't need to go big to make decent money in this business. You do have to have a degree of patience, however, okay, to be able to sustain positions long enough to see the fruition, okay, of trading sessions like this, okay? The other aspect that I want to really kind of hammer home, that I think that stands out the most, okay, deals with right here. There has been a big change, if you will, of tone in the markets, because everybody right now is focused China, trade war. Listen very carefully. The narrative is going to change, and going to change drastically. Everything we're going to start talking about, okay, is going to be yield curve. It's going to be about the Fed, and it's going to be about when is the cut going to come. Today, there was a drastic change. Look at this. This is where the current, again, this is the current Fed fund futures rate. I'll be very specific. This is where the Fed fund futures rate. This is the next meeting. Okay. This is the meeting after that, the meeting after that. When you start going out, all right, even to the September meeting, they're already pricing in a 50% chance of a cut by the September meeting. They're pricing in, okay, almost assuredly a cut by January. We're now talking about, again, Fed fund futures rates going back down. Why all of a sudden? Okay. Again, look for this narrative in the next couple of days. Why all of a sudden? Because the yield curve inverted again. The yield curve is ever so mildly inverted. The 10-year, okay, versus the 3-month. And again, I told you guys a couple of weeks ago this is likely to happen again. But the 3-month, okay, is now what? Exceeding the 10-year. That's the sign. It's a sign of a recession that is imminent. Okay. In fact, they say recession, but this is not the first time the yield curve inverted. This now, the 3rd, the 4th time's the charm over here. That is where, again, a lot of our focus is effectively going to be in the very, very near future. Now, with that and the yield curve effectively inverting, I want to scroll down for just a second and to bring into scope the financials, because here's where we think the most pain is likely to come. Okay, when it comes down to it, again, some really high-flying stocks got hit. But one thing that I have mentioned again and again, the financials set the tone for the overall S&Ps. And I'll leave you with this thought, okay, because it's critical. 2650 inside of the XLF. We are a hair above it, okay? But we started to see the financials get hit and hit hard as this day progressed, specifically because the yield curve. The moment the yield curve started to flip over, the financials really got rocked. And if you were a high-flying financial, as I said, some high-flying stocks got hit hard today. You start to look at stuff like Citigroup on a percentage basis. This thing was up almost 35% 2 weeks ago. Now it's only up 20%. Okay, that was over a 5% hit today. The marketplace, they didn't take into account any PE ratios, no fundamentals. If you were a top performer in your sector today, you simply got hit the hardest. There is where, again, we're going to find some opportunities again in the days to come. Do not count out the idea of the bounces. Right now, with the sell side activity hitting, this isn't the opportunity. Okay, listen, we're making money to the downside because we have a lot of bearish positions on. We're going to hold on to many of those bearish positions. We're even going to hold on to them in the midst of some of the bounces. But the real opportunity is going to come when we do have the bounce to put on that in and out spread, okay, to find different sectors that are outperforming, okay, the sell side activity of the marketplace, because sooner or later, they're going to hit them all. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.